Hey everyone, me Kevin here. Oh my gosh, Jerome Powell finally talked to the markets like we're freaking five. Rather than being a big D that he kind of was 2 Thursdays ago when he's like, look, you know what? Inflation going up, it's part of the game. We want that to happen. We want inflation going up. Is what it is. We're not doing anything. We're not going to do it. We're good. We're not going to do anything about it. That was his attitude 2 weeks ago. What happened? Market? Okay, Jerome, you got it. It was horrible. Finally, the next time Jerome goes to speak, today, he's actually chill. He's Mr. Chill today. And he's like, hey, I'll explain this to you like you're five. Let me make it very, very clear about expectations regarding inflation and other things. And finally, we get a clear, I mean, look, he's tried to be clear, but he just made it baby-proof today. So, what happened? Okay, first, let's talk about what happened, and then we'll explain everything he said in a nice little summary here. So, the first thing that happened is two things on the summary of economic projections that gave the market instant confidence. We saw yields come down, and we saw stocks go up. Now, I was expecting the Fed to kind of do the same thing like last time where they're like, I thought that was more of a likelihood. I also thought the Fed might have said something like, no, we're not changing anything, and the market would have gone down. I thought there was a greater chance of that. I was wrong, and I'm happy to be wrong on that because I don't want to be wrong. Like, I would rather be wrong and the market go up, right? Like, we don't need more pain in the market right now. We've had enough of that for the first quarter here, okay? But take a look at this. We go over here. These are the two big changes that we want to pay attention to. The first thing is, if we're going to see this massive inflation, then the summary of economic projections from the Fed would not tell us that, yeah, GDP is going to balloon in 2021. In other words, they're projecting this ballooning of 6.5% GDP. This is a revision upwards in 2021. But if we were concerned about like hyperinflation happening or the economy overheating, then these figures right here in 2022 and 2023, and then going down in the longer run, would not be essentially just plummeting. Like if the Federal Reserve and the board members thought, oh, the economy is going to overheat, this is really bad, and we started seeing GDP projections like 4% or, 3% over here and longer run adjustments. If we stay on this path, the GDP is going to explode because everybody's going out and they're spending way more money. They're saying, no, we don't see that happening. We think GDP is going to be stable and it's going to head down. We're going to see a short-term boost and it's stable and it's going to go down. People are like, but Kevin, aren't people going to go out and spend a bunch more money? The Fed's like, yeah. People are going to go out and spend more money, but then it's going to take a little bit of time for supply to catch up. We don't think prices are going to go up. We think people are just going to wait longer to get their products, kind of like the chip shortage you see with AMD and stuff. We don't see the actual chip prices going up. We're seeing, resale chip prices are going through the roof. It's freaking insane. You look at resale. Oh yeah, resale prices going up. But the manufacturers are like, hey, that's okay. We'll get through this backlog. No problem. Jerome Powell thinks we're going to see the same thing in other cases. Look, if everybody's traveling, no problem. I guess you'll just have to wait to get your plane ticket, or you have to go tomorrow or a different day on a cruise. It's all booked up. They're not worried about prices actually going up, and they're not worried about seeing GDP overheat. This right here, this one section highlighted on the sheet, in my opinion, was one of the two big things that got the markets to go, oh, maybe inflation isn't actually going to be that big of a deal because they don't think the GDP is going to overheat despite rates being at zero. That's a good thing. In addition to that, the second big thing that we want to pay attention to here is the fact that the Federal Reserve said right here that, look at this, previously they had inflation going from 1.8% to 2%. And that did not align with what the Federal Reserve said. The Federal Reserve has always come out over the past year, maybe not the past year, over the past 6 months, and they're like, we think there'll be a temporary boost in inflation, and then inflation will go down. And people are like, how are you saying that? But then in your economic projections, what you all think as a board, you think inflation is just in a linear pattern going to go up. Like, where's the spike and then the drop? Well, maybe now they realize, and as in a consensus, they're like, well, wait a minute, we should be a little more consistent here. Yeah, we do think inflation's going to go up. I mean, here, you're going to see this short-term bump in inflation. So they're revising their expectation for 2021 up to 2.4% average inflation for the entire year is the median projection now from the board. and then it's going to slowly decline. These two things here were basically the Federal Reserve finally going to the market. Look, we're telling you we don't think there's going to be inflation. We're telling you we don't think we're overheating. We're not worried about having to taper bonds yet. We're not worried about having to raise rates yet. Here you go. This is what we think. This was a big change, number one. We did have a couple dots get plotted for potential minor rate increases here in 2022 or 23, but nothing crazy. Maybe 0.5%, 0.75%, maybe. But Jerome Powell doesn't even think we're close to this. He says it's not even time to start thinking about raising rates. This is just, okay, a couple board members are like, maybe we should raise rates a little sooner. Who cares? He almost cast this aside as irrelevant. So what else did Jerome Powell say? Well, this is the part where he's really starting to talk to people like they're five, which was absolutely wonderful, which, by the way, is something that I like doing as well, going from talking to you like you're five about finance all the way up to advanced fundamental analysis in, of course, my programs on real estate or stocks, link down below, which you could still use that 38% off coupon code for, because we extended it for those stimulus checks arriving on the 17th and 19th. All right, so here's the baby talk, basically. So the big thing in the baby talk discussion has to do with supply and demand. And I love this discussion that Jerome Powell had. He did such a good job today explaining this stuff like we're five. People multiple times ask him, wait a minute, if we're going to see a bunch of demand all of a sudden come back, aren't we going to see a bunch of inflation? I mean, demand goes up. If supply can't keep up, they'll just raise the prices. Jerome made it clear here. He's like, no. And I've kind of already talked about this a little bit, so we're not going to be too redundant here. But he's making it clear, look, first of all, in America, we're really good at adjusting to supply. It's kind of like people are like, oh, gas prices are going to go up. Well, then we'll frack more and we'll refine more, right? People are like, oh, well, prices of goods and services might go up. Okay, well, then we'll wait and we'll adjust. Yeah, people are going to spend more for a short period of time, but that's going to be transient. It's not going to be persistent. In fact, Jerome Powell goes deep here in a simple way, and he says, look, for decades, we have been suffering declining inflation for decades. And these are very strong, what he calls inflation dynamics. They're not here today, gone tomorrow. These inflation dynamics, I kind of picture them like a big ogre moves really slowly, like, okay, low inflation environment sounds good. Really, really slow moving. It's not like a little mouse that's like here today, gone tomorrow. It's really slow, these dynamics, for them to change. And Jerome's saying, look, the way the dynamics are right now, pandemic or no pandemic, we're in a low interest rate environment. And he multiple times throughout his conversation said, look, we've had low interest rates, near basically zero interest rates for the good part of the last decade here. We haven't seen bubbles created. We haven't seen valuations go to insane levels. Sure, they might be historically high, but we haven't seen insane bubble economics. We haven't seen household debt go up. We haven't seen business debt go up, leading into the pandemic. Sure, we've seen some debt go up after the pandemic, but not to unsustainable levels. Jerome was really, really positive about the state of our economy. Jerome Powell further said that they were going to continue to make these bond purchases until we make substantial further progress. But the big thing that he really said, like he was talking to 5-year-olds today, was we will make substantial communication, or we will have substantial communication well in advance of us tapering bonds. In fact, he even gave us almost verbatim what he's planning on saying. He's planning on saying something to the effect of, we are now in a position where we're on a path to begin tapering bonds. That's what he told us. He's like, look, we've already got the verbiage to go, like, we're ready. That's what we're going to say. Not when all of a sudden we wake up one day and go, time to taper bonds. Oh, here's a statement. What? You're tapering bonds right now? No, he's going to talk to us well in advance of doing that. So then he talks about how any of these, this was another big one. Let me hit this really quick. The supplemental leverage ratio. So he's asked about this regarding banks. We talked about this yesterday about how, in my opinion, the Fed's just going to let this expire. I didn't think that the Fed was going to make an announcement today. While I was wrong about how clear they were on inflation here, I thought we were going to have a poopy-doopy Jerome today. We got a really optimistic Jerome Powell today, which was great, really good, market positive on that. I was right about the Fed just probably running the supplemental leverage ratio question up to the end of the month, because that provision expires March 31st. And he's saying, we'll get back to you in a couple weeks on this, which, surprise, surprise, that's literally the end of the month. And my expectation is on like March 31st or the last business day of the month, whatever that is, they're just going to go, yep, we're letting this expire. Bye. Like, it kind of doesn't want to draw attention to that right now. My expectation, and he was asked multiple times about that, at least twice about that, and he let that go. Then he was asked, which I thought was a really good question, he was asked, hey, what about the European recovery? Are they going to slow us down? And Jerome kind of dodged that question, but basically said, look, when the U.S. does well, the world does well. And U.S. demand is going to help prop everybody else up, so don't worry about it. We're all doing fine. Again, reiterated that asset valuations are somewhat elevated by some standards, but overall, any kind of short-term risks, we're not seeing any. They're not seeing major red flags right now. It's all focused on obviously getting out of this pandemic and reopening. He was asked a really good question about, hey, if inflation, and we kind of thought there might be a question about this. He was asked, hey, well, if inflation's at 2.4 and it's going to go down, why don't you just leave rates at 0? Obviously, he had to dodge this question. He totally dodged the question. I thought it was a brilliant question. But he says, look, we gave you our guidance. And the guidance is very clear that we want maximum employment and stable prices. And if we look at kind of the summary of economic projections, we kind of see that potential coming right around here. I'll show you. So we kind of see stable unemployment right around the 2022 to the longer run range right here. And then we see stable inflation, aka stable prices, right around here. Now keep in mind, when they say stable prices, they don't mean your stocks are stable. They mean consumer prices are stable. People's expectations for what they need to pay for travel and food and computers and clothing, all of it averaged together remains stable. And that's what we're expecting to see between 2022 and the longer run. Okay, moving on. I have to just applaud Jerome today. He did a really good job. And I'm not trying to shill the Fed here either. I'm just saying last time he pissed the market off because he was just being annoyed. Anyway, then he reiterated this. This was really good. So he talked about unemployment and how the Phillips curve is basically broken. We've heard him talk about that before, but there was something new that we haven't heard him talk about before. And that was something that he says about a connection between wage inflation and unemployment. And he says later in a cycle, and this is what I believe he means with late cycle behavior. I believe late cycle means when everyone's starting to benefit from a recovery. It doesn't mean the recovery is over or the boom is over or we're in a bubble that's about to pop. It just means when we're at later stages in the cycle, you have minorities benefiting just like non-minorities. You have different sexes benefiting just like the other sex, the opposite sex, right? Let's just be clear here, women benefiting like men, right? Or blacks and Hispanics benefiting like whites. Just make it clear. It is what it is. And so in a later part in our cycle, we have more of that benefit. Like in 2019, we finally started seeing minorities benefit from the recovery like whites were recovering better earlier. And so that's kind of what he's saying here. But a neat thing that he says is there's a connection between wage inflation and unemployment. And he says, late cycle behavior says companies absorb higher labor costs in their margin. Okay, so what does that mean? Jerome Powell is saying, look, when we get to later stages in a recovery, wages will start going up, but we don't actually have to see inflation because wages are going up, because companies are likely to just absorb that cost, basically having a lower net profit. The companies will just eat that rather than raise prices. So the Fed believes that companies are very reluctant to raise prices in this environment, that they'd rather take less profit, which sounds counterintuitive, but it's also very capitalistic. And the reason you would do that is because you want to maintain as much competitive edge as possible. And that's essentially what he's saying here. So, all right, modest increase in inflation. Okay, then he talked to us like we were little children about inflation, which honestly, this was probably the best part. I think I like this part so much, I need to put this up as like a standalone portion because this was just like, here, look, kids, you like rockets and going to the moon? Let me talk to you about inflation. And it was so beautiful. Anyway, he basically says, look, Yes, there are going to be modest increases in inflation. First of all, that sentence right there is way different from him 2 weeks ago. 2 weeks ago, yeah, we're going to see inflation, but we kind of want to see inflation. Now he's like, yeah, we're going to have modest increases in inflation, but those aren't permanent things. Sure, there are going to be short-term bumps, but they're going to go away. They're going to be one-time bulges. And then he goes on to say, like, look, the U.S. supply systems are very dynamic. People open up stores, people produce more products, people open up more shifts in the factories, and we're not going to see inflation or prices going up because of temporary supply problems. And then he reiterated this about inflation dynamics, which we already talked about in the video. And he even says, hey, look, we're going to see short-term bottlenecks, but it's not like supply won't be able to adapt. Such great lines. Oh my gosh, he talked to us like we were a child today. And the market liked it. The market overall liked it. The market overall bumped and stayed relatively bumped, which was very good. We didn't get ugly news today. We didn't get D-bag Jerome. We got really nice, let me console you and teach you, along with show you these economic projections that reiterate what I'm saying, to finally make you realize that inflation's not a problem. Now, the last time I talked about what the Fed said, who remembers this example? Me going, it's kind of like Jerome Powell is annoyed going home to his wife complaining about how people don't understand it. And he kind of came across as like grabbing you by the neck and going, no, inflation. That was so different today. Today's like, yeah, we're going to see modest bumps, but they're going to go away. Don't worry about it. It was like chill today. It was great. Anyway, that's what happened. And the stock market loved it. Bond yields went down. What do we got here right now? Let's look at this. We got the 10-year right now at 1.64, still elevated, but a nice decline after Jerome spoke. So a nice decline here. And volatility fell to 19.32. I'll hide myself for a second. Nice fall in volatility. And the 5-year, nice fall as well. So this is good. Very good news. Very good job, Jerome, for being a very good teacher today. Thank you, Jerome. Thank you so much for watching. Get yourself that 38% off. Oh, wait, wrong button. Get yourself that 38% off link down below. And folks, we'll see you in the next video. Bye.